வணக்கம். In last slide, we have discussed about market regulators. And this slide, we are going to discussing about the market segments. What is meant by market segments? Depending upon the product and risk and it needs, the entire share market or stock market is classified into three. The first one is equity. The more attracted investment options chosen by any investor is equity. Equity is really providing return more in future, sometimes immediately. That called it short term. Equity market or equity segment is played with number of shares. One is equity shares. It is popularly that equity is called the equity shares. It represents the form of fractional ownership in a business venture. Actually, the companies are collectively owned by equity shareholders. Being the owner of the company, they have to bear the risk. Because of this, they enjoy the rewards in future. The next one is a depository receipt. It's a negotiable instrument in the form of certificate denominated in US dollars. The certificates are issued by an overseas depository bank against certain underlying stock and shares and controlled by custodians. These DRs can be issued outside the India, only outside the India. Can be the other two types. One is ADR, another one is the GDR. That is ADR means American Deposit Receipt and GDR means Global Deposit Receipts. ADR which is meant for America and GDR which is meant for European market. It's type of equity rights issued to the foreign investor. And next followed by debentures. They are instruments for raising long-term debt. Debentures in India are typically secured by tangible assets. There are fully convertible, non-convertible and partly convertible debentures. This is mostly suited to investors though are not interested to take more risk and they need a return, but with a limited amount of risk, they can go for the debentures. Next one is a warrant. It's another type of the debenture. It's entitled an investor to buy equity shares after a specified time period at a given price, which means initially it cannot be issued with the securities, but after some time that debentures are there that warrants can be converted into equity shares. The next one, the popular brand, it's called mutual funds. I have a wish to make my investment in the equity shares or equities. Fortunately, I may not be possible to have that much of money to keep my investment in the equity market. For those type of people or those group of people, the another segment, the another type of industry which is generated is a mutual fund industry. That mutual fund industry itself, it's a financial vehicle promoted for the benefit of very small investor. People who are having the very nominal amount, maybe 100 rupees or 500 rupees or 1000 rupees by monthly or weekly or so on, they go and invest their money in mutual funds. In turn, the mutual funds invest the money in the equity market. So indirectly, the mutual fund investments are go to the equity market. It is also provide the more return. These are all equity shares, deposit receipts, and debentures come under the equity segment. Followed by the debt. Already I have said that debt segment is the very protective segment, or maybe a restricted segment by means of risk. When compared to the equity, debt is not a riskless investment made by investor who are not ready to take the more risk. They can go to the debt market to enjoy the benefit of return as well as the less risk. This market is consist of the two market. One is government securities market and another one is the corporate bond market. Government securities market is the market where the government is generating the loan or maybe getting the money from the public. Why government is required? Government is also having the so many number of plans for the benefit of the public. For maturing the plan, they need the money. To act the plan, need the money. For that reason, the government is going to be issue the securities and get the loan from general public. This government securities are both for short term as well as in the long term nature. These securities are guaranteed by government, so the possibility of default is zero, and it also so well protected, and assurance of the return is compulsory. This government securities also call it as gilt edged securities. Followed by corporate bond market. This market is meant for where debt securities of corporate are issued and traded therein. Corporate bonds are usually issued by companies to meet their needs of money. Already you are aware that companies can go for the equities also for their capital, but sometimes the company wants to that particular capital which is meant for not a long term, which is meant for the short term nature, and the companies can go for the corporate bond market. This market is comparably is riskier than government securities, provided these are all issued under the private sector. Followed by derivatives, the most magic word used in the securities market or financial market is derivatives. Derivatives means the return of one asset or the return of the one instrument or the return of the one security is depend on the other security, which is called the derivatives. For example, A security and B security. The return of the A security is deriving from the B security. That security is called derivatives. Derivative, it's a product whose value is derived from the value of one or more basic variables. It's called basis. That basis may be an underlying asset, an index, or a reference rate. This particular derivatives segment is having there the number of participants. Derivatives already we have discussed. Next one, index or stock futures, index or stock options, currency derivatives, commodity derivatives, and interest rate futures. This and all we discussed in the followed slides. Thank you.